Good morning, everybody. It's Thursday, September 12th, 5:27 a.m. Central Time. Grain markets are higher this morning. December corn futures up 4 at 408 and 3/4. November soybeans up 6 at 1006 and a half. December Chicago wheat up 7 1/4 at 586 and a half. December Kansas City wheat up 7 1/4 at 595 and a half. December spring wheat up 5 3/4 at 622 and a quarter. We do have a USDA report today. Let's start there.
We sure do. So USDA will release its monthly crop production and WASDE report this morning at 11 a.m. Central Time. All eyes will be on the U.S. corn and soybean production estimates. The government will incorporate objective yield data into its corn and soybean yield estimates for the first time this year. Last month's yield estimates were primarily survey-based. Traders expect a small reduction in the U.S. national corn yield estimate compared to last month and a mostly unchanged soybean yield estimate. Drier weather in the far eastern Corn Belt has led some traders to believe that the highest yield estimates of the year were posted last month.
All eyes will absolutely be on the corn and soybean production estimates and the yield numbers in particular. I'll read you a couple of excerpts here from last September's report and how they kind of shift methodology. In August, it's almost all survey based, and now they're going to incorporate objective yield data. This is from the survey procedures. Objective yield and farm operator surveys were conducted between August 25th and September 7th to gather information on expected yields as of September 1st. The objective yield surveys for corn, cotton, and soybeans were conducted in the major producing states that usually account for 75% of U.S. production. Farm operators selected for the objective yield survey were interviewed to update previously reported acreage data and seek permission to randomly locate 2 sample plots in selected fields for the objective yield survey. The farm operator survey was conducted primarily by telephone with use of some mail, internet, and personal interviews. Approximately 7,000 producers were interviewed during the survey period and asked questions about probable yield. So you've got some different methodology, which leads you to potentially different outcomes. The trade believes that the corn yield number is going to come down a little bit versus last month, and that the soybean yield number will be largely unchanged to maybe slightly lower, depending on which survey you look at. I'm not overly, the carryout numbers will be largely a function of the yield numbers. I don't know that they're going to change a whole lot for new crop demand. It's very early. World numbers, you could see some changes there. The drought that onset fairly rapidly in the eastern Corn Belt, Ohio in particular, is problematic. And we also had heat above normal temperatures during the last 10 days of August. Was that enough to really set the crops back? I think some people would argue it's probably too late for corn, but maybe soybeans were set back. And if they were set back, was the survey period during that, last week of August, first week of September, was that enough to catch it? Was it early enough to catch it? I don't know, and we'll find that out. This is going to be a argue with USDA day for a lot of people, I have a feeling, but we'll see what happens.
Russian grain exports are slated to decline this year. The Rostov region, which is known to be a breadbasket, experienced early spring frosts and drought. The region accounted for more than 11% of Russia's total grain harvest back in 2023, but production is anticipated to fall by 30% this year. Russia is still estimating this year's total grain production at 132 million metric tons. The country's export forecast has yet to be released. The absence of TDRIF, the country's largest grain trader, will also have an impact on exports. Following months of problems with authorities, the company will not be doing business this year.
Russia is projected to be the top wheat exporter on the planet, and they have a drought, dry conditions, problems. It's planting season, largely. Some areas have been planted, some have not. So it's early, and there's this can be fixed, I think, still. When you look at Russia and also Ukraine, they together are projected to account for 29% of all global wheat exports this year. So this region is a big deal, and they've got some early season crop problems. Here's a map on the left from our friends at World Weather. Most of your Russian winter wheat production is in that area between the two seas, and there's a lot of red there on the map, your 7-day subsoil. So it's a real problem, and I think traders are starting to pay attention. You see wheat futures, they're trading above some resistance on the charts this morning. I talked about that in our email earlier today. So absolutely bears watching. And if the trade believes this is becoming a more real problem, the wheat market can absolutely react because it's been down and out for a long time.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about yesterday's premium video with Brian Split?
Our good friend Brian Split was on yesterday. We talked about charts. Have corn and soybeans bottomed? There is some evidence from a technical standpoint to believe that maybe that's the case. And Brian talked about some circumstances and past circumstances in which the market posts lows in August and then makes fresh lows after that, and how bad those fresh lows can be if there's another low after August. Is super interesting stuff. Brian actually led off with cattle, which he thinks is one of the more interesting charts out there. Brian's stuff is always fantastic. He's on every other Wednesday. If you want to see the premium stuff, guys, go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. Remember, guys, this is the best way to support what we're doing here. The podcast doesn't pay us anything. YouTube pays us enough to keep the lights on. This is why we're able to do what we do. If you're a premium sub, we absolutely love you to death. And if you are not, you should give it a shot this morning.
Low water levels on the Mississippi River are cutting into farmer profits. Barge companies are being forced to limit the amount of grain that cargoes can carry. About 60% of U.S. grain exports are shipped down the Mississippi for export. According to the USDA, as of the week ending August 31st, grain shipments on the Mississippi declined 17% compared to the previous week. Besides limiting shipments, low water levels are also causing freight costs to rise. Compared to the 3-year average, freight rates in St. Louis are up 57% and rates in Memphis are 63% higher. The low water levels are a stark contrast to a few months ago when the river reached major flood levels in the northern Corn Belt.
So I think we've talked about this every day this week because it is important, and it's making U.S. soybeans in particular less competitive on the export market. So yeah, 2 months ago, we were above flood stage north of St. Louis, and since then we have dropped rapidly. I talked about this yesterday, and I questioned why. And I think that to go back to the drought monitor, a lot of this has to do with drought in the Ohio River Valley. This is a direct quote from the article. All that water flowing down from the upper Mississippi was offset by drought in states along the Ohio River, which feeds into the Mississippi at Illinois. Rainfall in places like Ohio and West Virginia was minimal throughout the summer, worsening in August. There's not a whole lot of relief here. The government continues to project that we're going to be kind of flat to lower in terms of river levels, which are already restrictive. And as we discussed earlier this week, we are approaching primetime U.S. soybean shipping season, and we ship 60% of the beans we ship go out through the river and through the Gulf. So we could use some improvement here.
U.S. ethanol production was strong last week. Weekly output of 1.08 million barrels per day was up 1.8% on the week and up 6.7% versus the same week last year. Ethanol stocks were pegged at 23.7 million barrels. The print was up 1.5% compared to the previous week and up 9.7% compared to the same week last year. Implied gasoline demand was down 5.1% compared to the previous week and down 9% versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is down slightly compared to the same period last year.
Corn demand via ethanol is 36 to 37% of all demand for U.S. corn. That's what it's projected to be this year. USDA, this is kind of interesting. USDA in its most recent projection says that corn demand via ethanol will be unchanged this current marketing year that just started versus the previous marketing year. And I think that some people, I read this in a couple different places, have reason to believe that corn demand via ethanol could actually be a little bit stronger. We've got cheap corn. We've got pretty good margins. We may need to rely on ethanol exports a little bit. But if that's the case, it could be a big positive, and you could easily pull some additional bushels into ethanol production, which would be very, very good. So this is absolutely a bright spot with regard to demand, no doubt about it.
Inflation has fallen to its lowest level since February 2021. The CPI rose 2.5% in August compared to a year earlier. On a monthly basis, consumer prices last month were unchanged from July. Economists were expecting a 2.6% annual gain and a 0.2% increase for the month. The data almost guarantees that the Federal Reserve will cut rates by a 0.25 percentage point at its meeting next week. Despite the lower inflation reading, the overall CPI is still about 21% higher than it was before the pandemic back in February of 2020.
So we still have inflation. The prices of things are still moving higher. It just so happens that the annualized increase of 2.5% is the lowest monthly annualized increase since February of 2021, when we were on the way up Peak CPI was 9.1% in June of 2022. And make no mistake, the index is still made another record high last month. It just so happens that the slope at which it moves higher is not as steep as it had been. So yes, things are as expensive as they've ever been. The CPI is up almost 22% since your last pre-COVID month, which was February of 2020. But inflation is easing, and there is almost now a guarantee that the Fed cuts by a quarter point next week. There's an 87% chance based on the Treasury markets that you'll see a quarter point cut and a much smaller chance of a half point cut. What did cattle do yesterday?
Cattle futures were higher yesterday. Live cattle were up 55 cents to 90 cents higher. Feeders were up $1.20 all the way up to 210. Box beef was lower. Choice ended the day at 307.36. That was down 87 cents. And select ended the day at 294.38. That was down 263.
Outside markets, U.S. dollar is flat this morning. The stocks had a wild day yesterday. The S&P was down like 2.5% and finished like with gains of more than 1%. It's kind of a whipsaw. There were first we had CPI out and went lower, and then there were some tech earnings out. We went back higher. The Dow's up 80. Bonds are off. Gold's up $3. Crude oil's up $1.11 in the October WTI. It's 68.42. Remember, guys, report at 11 o'clock Central. Have a great day. We'll talk to you on Friday.